Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
Hey, and welcome to another episode of the Asian Connection Mortgage Podcast. I'm your host, John Lee, mortgage broker located in Vancouver, BC, in Canada. And today we're unpacking a strategy that many Canadians may have heard about, but don't really know what it's all about. It's the Smith maneuver. So what is it? How does it work? And is it right for you? Well, we're going to go over all of this and talk about it right now. So let's start with the basics. So what is the Smith maneuver? So the Smith maneuver is a Canadian wealth building strategy developed by a guy named Fraser Smith. His family is still running this company that educates people on how to use this strategy. So simply put, it's a method that allows homeowners to make the interest that they pay on their mortgage tax deductible, while simultaneously investing to build wealth. So in many countries, including Canada, the interest you pay on your principal residence mortgage is not tax deductible. However, so this is where the whole loophole is that if you have an investment loan, the interest will be tax deductible. And the Smith maneuver takes advantage of this by gradually converting your non-deductible mortgage into a tax-deductible investment loan over time. So how does this all work? So here are the step-by-steps. There are a lot of steps, so I'm going to give you all the steps and also give you an example as well. So the very first step, when you do get a mortgage, and if you get this wrong, then you can't take advantage of the Smith maneuver, okay? The very first step is to get a re-advanceable mortgage. So the mortgage that you need is a special one. It's called re-advanceable mortgage. I also like to call it a hybrid mortgage. Basically, it's a combination of your mortgage and a home equity line of credit. And how it works is that as you pay down the principal, then your home line of credit limit increases. So every time you make a mortgage payment, a portion goes to interest and a portion goes towards paying down your principal. And the amount of principal that you pay off over time will be consistent with the increasing borrowing room that you have in your home equity line of credit. Now, that's the first part. And this is where the Smith maneuver comes in. So as you pay down your mortgage for your home, that's not tax deductible. But then remember, your home equity line of credit, the credit limit increases. So what you're going to do is you're going to draw out the money from your home equity line of credit, borrow against it, and then you're going to use that money, open up a investing account, a non-registered investing account, where you can buy, stocks, mutual funds, or ETFs, whatever you like. And because you are using your money to invest, now the interest that you're paying on your home equity line of credit, that portion is now tax deductible. So you're going to do this every single month, every time you make a payment, because every payment, money goes towards principal. Your home equity line of credit, the credit limit increases. You're going to draw it out, put it into your non-registered investment account, and then invest. So why is this really good? It's because you're essentially, we call it double dipping your money. So when you are putting money towards your house or paying down your mortgage, that doesn't really do anything to your home value. So imagine like someone's looking to buy a house. They're going to look at your house and be like, oh, nice kitchen, nice bathroom. No one's going to be like, oh, how much do you have in your mortgage? Like that is not even part of the equation. They couldn't care less. But lots of Canadians, they're like, oh, I want to like pay down our mortgage and this and all that, which is great because I think the dream is always to be mortgage free. But the money that you put into the mortgage isn't really working for you. Like you're just paying down your mortgage and that's it. But when you are drawing out back the equity and then now you're investing something, now we call it double dipping because one is you're holding an asset, which is real estate, which hopefully long term, just talking long term, it should go up. And now once you pull out that equity, you put it into your non-registered account to invest. Now you have two assets that's growing for you again long term. So before, if you're not drawing it out, it's just a house, which again, no one really cares what your mortgage balance is. But now you draw it out. Now you have house and then stocks that will grow long term. So here's a more in-depth example. If you're watching this on YouTube, we're going to have this on the screen so you can go over it easier. So here's the example. Let's start off with someone who's buying a house, $1 million. And they can borrow up to 80% loan to value. So for the mortgage portion, they're going to have $800,000. Because they're borrowing to the max, they're not going to get any home equity line of credit until they start paying it down. The mortgage rate, again, we're just gonna use simple numbers, okay? 4.5%. The home equity line of credit rate will be 5%. And from the investment that you're going to transfer into a non-registered account, the expected return for that long term, 7%. Okay. So here's how we're going to do it. So we got a $800,000 mortgage and your monthly payment is going to be $4,400. Your very first month, this $4,400 payment, $3,000 of that will go towards interest, and $1,400 will go towards principal. So with each monthly payment, about $1,400 of that goes towards principal and starts paying down your mortgage. And whenever you do this, then 1,400 credit limit increases from your home equity line of credit, which allows you to draw it out to invest. Continue doing this every single month. And at the end of 1 year, so 1,400 of the principal times 12 months, you're going to be paying down your principal by $16,800. And now let's break this down because you're going to be borrowing this. So assuming that you borrow the whole amount, again, using very simple numbers, you borrow the whole amount for the whole year at 5% for the home equity line of credit, that's $900. So this $900, now you can write it off because you're using this amount to invest. You're going to get a tax refund. So I'm just going to assume your tax bracket is like, say, 40% or something. And you're going to get a tax refund of $400. Your investment return, remember investment return is 7%. So we're going to invest 16,800 at 7%. Your return is $1,200. So at the end of 1 year, you're going to have the 16,800 in your portfolio plus your return, which is $1,200. So in total, it will be $18,000. So your wealth has grown about $1,200 at the end of 1 year. Now, at the end of 5 years, which say it's at the end of your mortgage term, you continue to do this consistently and with lots of discipline, you would have invested $89,000. Your home equity line of credit will be $4,500. You get a tax refund of $1,800. and your portfolio is now 105,000. So you can see that as you're doing this, your home price is still the same whether or not you do this or not. It could go up or down depending on the market, but assuming long term, it should grow as well. And on top of that, now you have an additional portfolio of $105,000 working for you while you sleep. So that is the Smith maneuver in a nutshell. Of course, that's just an example. We gotta see whether or not it's the right fit for you. So the key points, is again just reviewing everything. Is every mortgage payment goes towards principal, and then now it increases the borrow room, and now you can draw it back out to invest. And remember to invest it into a non-registered account because you have to pay taxes on that, on the returns. Therefore, you can now uh, use your home equity line of credit to be tax deductible. So I'm sure this is probably still a little bit confusing. If you do want to um, contact me to discuss more, I'm happy to go over the scenario specifically for you. This is a great way to allow you to grow your wealth, especially in places like Vancouver and Toronto when everything seems to be so expensive. You just really need different strategies to grow your wealth instead of just trying to make money through your job or your business. So here are the pros and cons to the Smith maneuver. So the pro, obviously, you're turning your non-tax deductible mortgage into a tax deductible, and then you're also reducing your bill and you're growing your wealth. So these are all great. The cons would be that it is risky. So essentially, what you're doing is you are leveraging an investment. You're borrowing to invest. Some people they don't like that because this is a very nice example, whereas like every single year you're guaranteed 7%. Well, really, the market doesn't happen that way. Sometimes it could be 7, 10, it could be 20, sometimes it be minus 10 or 20. But your borrowing cost still stays consistent. So some people, they might not be comfortable with that, but understand that when you're doing this, you're doing it for a long term. So even though there's a risk involved, if you're disciplined and do it consistently and you are more savvy when it comes to investing, you understand how this strategy works and it minimizes the risk. You will also have a cash flow situation. So when you are borrowing your home equity line of credit, you're borrowing, you still need to pay monthly interest payments on that. So some people, again, they might not be comfortable because they're like, oh, I'm paying $4,000 already, and you're asking me to pay more into the home equity line of credit because I'm drawing it out. So that's another con. And last thing, discipline. So it's easier said than done. It is actually very easy, but to do it consistently on top of all the things that's happening in your life, um, it can be difficult. So you'll probably need like reminders, spreadsheets, and so on to really make sure that you execute this maneuver properly. So this is again not for everyone. Um, so make sure you know what the risks are, know what you're getting into, and make sure you seek a professional to help you execute it. So there you go. I hope this is a good overview of the Smith maneuver. Again, contact me if you have any questions. I'm happy to go over it with you and to create the scenario specific to your case. Thanks again for listening, and I'll see you in the next episode.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the